Hello and welcome to CNBC Africa's special broadcast of Nigeria's Monetary Policy Committee meeting. I am Wale Famirewa and thank you for joining us. As Nigeria works hard on economic recovery, inflationary pressures continue to raise concerns as headline inflation for December hit 15.75%. That undoubtedly will be one of the key considerations of the MPC today. You may recall that in its last meeting in November, the MPC voted unanimously to keep its benchmark rate on hold at 11.5%, and this came after a surprise 100 basis points cut in its September meeting. And that was combined with an adjustment of plus 100 and minus 700 basis points on the asymmetric corridor around the monetary policy rate. So what can we expect in today's meeting? Joining me to preview the decision today, my guests are Bismarck Rewane, the CEO of Financial Derivatives. We also have Nnamdi Nwizu, Co-Managing Partner at Comercio Partners. And Abdulrahman Yinusa is the former council member of the Chartered Institute of Bankers of Nigeria. Gentlemen, thank you so much for joining us this afternoon. So the first meeting of the year, I would like to start with you, Bismarck. What do you think is would probably be the key talking point at this MPC, and how do you see that reflecting in its decision?
The major concerns will be the rate of inflation, especially food inflation, core inflation, rural and urban inflation, and headline inflation. The range for the central bank is 6 to 9%. Headline inflation at 15.75% is worrying, but at the same time, the economy is facing sluggish growth. So how do you introduce monetary policy measures that will actually contradict the growth objectives of the fiscal authorities? So I'm saying that at this point in time, it's difficult to speculate, but most likely, the most likely outcome is probably holding rates as they are, because this is like a no-win situation as far as any monetary policy authority is concerned at this time.
Well, if we consider its decision at its last meeting, no change, and it was an unanimous vote at the time. So one can imagine that the circumstances are very similar, although many will point to hopes of V-shaped recovery globally, given what is happening with the rollout of vaccines to address the coronavirus pandemic. But staying with you, Bismarck, don't you think that it's a no-brainer that they will simply keep everything unchanged as they did at the last meeting?
I think they will do that, but you cannot take away the fact that at 15.75% headline inflation and interest rates, treasury rates at 1%, that it must be very concerning for any policymaker to leave interest rates the way they are. Although, having said that, the MPR as an anchor rate has become meaningless. So what is actually more important today is the treasury bill rate, because the bulk of the monies of institutional investors have gone into treasury bills and other fixed income securities. And also the other concern is the asset bubble that is being built in the equity markets, which, if anything happens, the risks that will unfold will be similar to that what happened in 2009. So I think bearing the risk in mind, 1, 2, the rate of inflation, and then 3, the fact that even in Q4 growth that is going to come out next month, the figures are not likely to be very encouraging. So the best thing to do is to wait and do nothing at this point in time, and then gradually after the meeting, you start to address the other, tinker with the reserve levels, and also bearing in mind the exchange rate. The exchange rate pressures could begin to bear as long as if you are going to address output at this time.
Right. Okay, so that's for the meeting today. But let me come to you now, Nnamdi. And obviously, monetary policy, in terms of the mechanics and how the central bank implements this, goes beyond its decision at its MPC meetings. So I want to hear from you about what you're reading into the moves, if you like, the body language of the central bank in the fixed income markets and the forex markets. What does that tell you about how the central bank is likely to play this out in terms of the twin challenge of rising inflation and then, of course, the pressure to get some rapid economic recovery?
Yeah, thanks, buddy. So we've seen these, or what we believe, or what we've heard, is that the central bank seems to be very much concerned around FPIs and the fact that we've not been seeing a lot of foreign portfolio flows coming into the country. If you look at the FPI figures comparing Q3 2019 and Q3 2020, you have like an 86% drop, especially when you look at your money market instruments, which have dropped by roughly about 85%. And money market instruments will be basically things like treasury bills and OMO. So since we have the reduction in OMO rates, we've basically seen a death of foreign portfolio investors. Yes, they are considered to be hot money and might not be the best for an economy trying to grow. But for most people, FDIs, for most economies, the FDIs follow the FPIs. So after you have the portfolio investors, they have the direct, foreign direct investors who now end up coming in and help stabilize the currency. But we've seen countries like Egypt and co, ended up raising their rates and also devaluing their currency to attract portfolio investors, foreign portfolio investors. And so far, we've seen the benefits. So definitely something that we've seen the central bank show some concern around, and we definitely know it's playing in their minds. So for them, they might not necessarily have to increase rates. We've seen that for the past few meetings, not really much the MPC has done has really affected the market, but more of the unorthodox methods that the central bank uses. For instance, OMO rates, all they need to do would be to increase the rates of for OMO and also increase the issuance amount or allocation amount that they have if they're trying to attract foreign investors. But to do that, they should also be mindful of the wide arbitrage opportunity that you have in the market between naturally the OMO rates and the secondary market rates. So they might also need to look for a way to address that also in the market. But definitely they would need to find a way to start to push up rates. And like I said earlier, so they've shown some concern around that from what we've heard.
All right. Clearly, unorthodox methods are in play here. And the big question is whether or not they will work in terms of how they can get the foreign portfolio investors back in the market. And I wanted to hear your thoughts about that, because if we look back 4 years ago when we saw a very similar situation play out, very low oil prices, and we saw the impact on the forex markets here. And we had, in that case, the central bank creating the investor and exporter window. But now, one has to ask the question, what can the central bank potentially create to get the foreign investors back interested in the market? And I'm still staying with you, Nnamdi, on this point. What options do you think the central bank has, apart from simply just, if you like, speaking to them and appealing to them to come back and asking them what they want? What do you think the central bank can do?
So beyond generally including interest rates, you still have the big elephant in the room, which would be liberalizing the FX market. We know that more or less it's been a bit stifled and frozen over the last few years. That is something that would make a remarkable difference. Allow market trade freely, allow banks start to show two-way quotes like they did in the past, and intervene when you deem fit. We saw that happen, or central bank used to do that, say, about 4 or 5 years ago. But we know that in the last few years, it's more or less been like a fiat market sort of. So that is something that would definitely give a major boost. One other thing would be something that we haven't looked at in a while, also the JP Morgan index. So if we can get into some of these indexes, then definitely you start to see a lot more attraction for the Nigerian sovereign bonds. But to do that, once again, you still come back to what you're going to do with allowing the currency flow, right, freely. That will be a major game changer if somehow they can achieve that.
All right. Thank you so much for that interesting perspective there. So I'm coming to you right now, Abdulrahman, and if you can, for a moment, wear the hat of a CFO, which I know you have. many years ago. When you take a look at the markets today, we're seeing inflation at a 3-year high, well over 15%. For food, inflation is closer to 20%. And you see those extremely low interest rates that we're seeing in the T-bill market and the fixed income markets in general. Does that scare you? I want to hear your thoughts about how you think this can play out. What do you see coming, given the situation we have right now?
Thank you, Wale. And looking at the current situation of the monetary situation in the system, I think it's a no-win situation because most of the issues are structural. If, as a bank, you are no longer able to make investment in T-bills to cover your cost of deposits and cost of transactions, and FX is already restricted in terms of volume, and we're having challenges with inflow from the foreign direct investment. Clearly, a lot of negatives are piling up against the banks. So lending, obviously, is a natural outlet when you have such excess liquidity in the system. And unfortunately, availability of liquidity is not the primary reason for lending. That is actually a necessary, but not a sufficient enough reason for you to lend. The original reason for you to lend is whether the investment options are bankable and whether the overall system suggests that you are going to get your loan repayment back. Otherwise, you are going to be hit with loan losses down the line. So I will say the central bank is in a very tough place right now in terms of struggling to grow output because I saw in the last MPC communication that the CBN is actually postulating that we can possibly be out of recession by end of 2021. I don't particularly subscribe to that degree of optimism, but for them to make that statement, it means therefore that they will be struggling to see how output growth can be enhanced. Because fundamentally, the inflation situation in Nigeria, and I guess in most parts of the world, has to do with disruption to supply rather than increase in demand. So fundamentally, until we're able to get out of the rigidities that is around the supply system in this time of COVID, it's unlikely that anybody can get inflation under control. And clearly, if you want to move out output, you're going to have to pump a bit of more money into the economy, which means therefore that the very tools that you are going to use to improve output is the very same tools that are going to have negative effect on inflation. So it's a catch-22. Which one are we going to focus on first? And if you choose to focus on output and take a risk on the inflation, then you have a problem with FX management on the other side. So these are the variables that I think the MPC will have to struggle with at the meeting today.
All right, before we cross to Abuja to hear from the CBN governor, Bismarck, I would like to hear your thoughts on the broader economy, because that's really what underlies everything, fiscal and monetary policy. And the picture doesn't look very good. The World Bank projecting that we could see just about 1% growth this year. Many are suggesting that we're not out of the woods yet, even though we have seen that oil price recovery. But when you look at the fiscal conditions that the government really finds itself in at the moment in terms of revenues, it's really a tough situation. So I wanted to hear your thoughts about macro policy now, focusing for a moment on the fiscal authorities. Your thoughts?
Well, I'm not so sure that the picture is as bleak as is being painted. Firstly, I think the price of oil at 56.50 is at least 50% higher than what it was about a year ago, during the pandemic. That's one. Two, production in about 1.6 million barrels, or 1.5, 1.6 million barrels. The reserves have gone up to $36 billion. So in dealing with output, all we need to do is to actually stop the rationing. If you stop the rationing and say, let us say, for example, the central bank was to sell $4 to $5 billion into the market, output will increase. The arbitrage between the parallel and the official market will narrow, and confidence will restore, because demand for forex in this hard economic times is not as high as it was. What is lacking is actually the confidence in the system. So broadly speaking, in terms of the macroeconomic fundamentals, the price of oil has come up. The price of the production is stable at the OPEC level. I think that the federal government fiscal revenue, because subsidies, the petroleum price subsidy has been actually reduced. The PIGB is being passed. So there are some good things that can. All we need to do is to one, allow interest rates in the treasury, the artificially low interest rates in the treasury market, to come up closely, not as high as the rate of inflation, but definitely moving in that direction. That will increase national savings, and output will have been increased. Inflation begins to come down because output is increasing. Then you are getting closer. But what we have today is a major distortion. You cannot have inflation at 16% and treasury bill rates at 0.5%. Yinusa said, and I correct him there, the central bank says
on that point, Bismarck, sorry to interject, because I asked this Abdulrahman the same question. How concerned or scared is he about that dynamic where we are seeing extremely low interest rates and high inflation? What do you think will be the cost of this if this situation is not addressed at some point by the central bank?
First of all, your national savings rate drops. And once your savings rate drops, your level of investment, domestic investment, comes down. My other colleague here spoke about the fact that FPIs will not come in because the interest rates are low. So your investment flows drop. Your diaspora flows are already suffering because of the diaspora remittances and all the other problems. So what you need to do is to allow market forces to, one, allow the exchange rate move a little bit, allow interest rates begin to climb back up so that you are getting towards equilibrium. What we have now is a static disequilibrium, which is not fair. And what is going to happen is that it will lead to distortions. And what you're going to be doing is putting out fires. So I think the central bank, there are enough economists within the central bank, and good ones for that matter, who will advise policymakers that policy making is to change investment behavior and patterns. And you don't have to go from 0 to 10. Even if you move from 0 to 2, the directional and the signal you send will anchor expectations. And once that is happening and people begin to move towards equilibrium, both the banks, who are the transmission agents, the markets, who are the recipients of this, and policymakers will be more aligned. That's my view.
Right. Okay, let's get the perspective of a trader now. Nnamdi, pretty much the same question. When you take a look at that, very low interest rates and high inflation, from your experience, is this a recipe for disaster several months down the line, or do you think there's a way we can still navigate through this? What, in your view, are the costs of this equilibrium, if you like?
Well, from a market perspective, there's always a belief that the market always wins eventually. So if you look at it, in the last, say, 1 month, we've seen roughly about a 300 basis points rise in yields across from the short end down to the long end. Right now, you have the 2050s, which are trading at about 7%, now trading at about 10.1, 10.2%. So it gets to a point where fundamentals would always end up coming back and fundamentals would always win. So the general belief in the market is that government has a huge budget deficit. The government has to borrow this year. They don't have a choice. And also, we don't have as much maturities as you had last year. So you have about 4 trillion in almost maturing this year versus about 14 trillion you had last year. A lot of it has gone out of the market due to the central bank, CRR, the CRR and special bills are the issue. So they've been able to mop up a lot of liquidity. So the amount of excess liquidity they had last year just isn't there this year. So eventually, yields would have to normalize. And like I said earlier, we've already started seeing that happen across board. You can't continue to keep rates low. And the thing about this is that the people who bought this yield at 7% and they're now trading at 10 and eventually maybe go back up to about 12 or 13%, would be reluctant to come back into the fixed income market for a while because they would have suffered huge losses, right? So in a way, yes, it's a recipe for disaster because they're going to have a lot of losses in people's books, both the pension funds and the banks and those who trade their books. And you're going to have the government start to struggle to borrow from the market unless the rates start to go up. And then you're not going to have your FPIs coming in unless they see the rates go up and they see the currency start to normalize or trade a bit freely. So you have so many things that need to come together for us to have. You can only manage with the ad hoc policies or the unorthodox methods for so long. Eventually, fundamentals creep back into the market and things start to normalize.
Right, I hear you, and it does sound like at some point the central bank will really have to, if I can use the phrase, bow to the reality of the situation. If we're going to really get those foreign portfolio investors back into the market, then we simply have to tweak the situation so that it's more friendly for investments. Before I let you go, and then we go to the central bank governor, Nnamdi, very quick comment on forex policy and what we could be hearing from this MPC. Because as you know, we've seen some Naira weakness this week in the I&E window and of course in the parallel market. We've also seen the central bank put out a circular insisting that exporters must repatriate their export proceeds and bring more liquidity to the market. Otherwise, they'll be barred from the banking system, if you like, because essentially the central bank has said they would not be able to transact in the banking system at all. But your thoughts on what the MPC needs to say around forex policy, because really that is the elephant in the room. If we're going to get foreign investors back in, we've got to fix forex policy.
Yeah, so what they need to say and what they would say are two different things. What they need to say would be liberalizing the market, right? And possibly devaluing the currency a little bit to reduce the spread between the parallel market and the official rate. That's what they need to say. But what they might say might be more of talking about the pressures that we've seen and how you have a lot of people who are basically speculating and also who are like the exporters who are refusing to bring back their export proceeds and how they need to get tougher on them. Basically, once again, more of the unorthodox methods versus the market-oriented methods which we need. So I don't really expect a lot of changes from the MPC. Besides, the central bank tends to do quite a bit outside of the MPC meeting, which we already know has large impacts on the market. So I don't expect to see so much from them on the FX market.
Right. Abdulrahman, if I can get you to chime in on this point of around investor fatigue. And I imagine that this is something that we may begin to speak about a lot more in the months ahead, because as you know, the foreign portfolio investors have already shown their fatigue. They are not putting new capital into Nigeria. We know foreign direct investments dropped last year, even though Nigeria continues to lead sub-Saharan Africa in terms of inflows. But at some point, if we don't get the environment fixed and more welcoming, one could really lose out in the medium to long term. Are you concerned about that, or do you think that it's really a question of just give us what we want in terms of forex policy and we're back in?
Yeah, well, I think the issue definitely goes far beyond the forex rates and the forex issues. You recall that even back in the States, a new finance secretary, or the treasury secretary as they call it, has just been appointed. And that lady is one of those who believe in pumping a lot of funds into the economy to galvanize the system. So I will reckon that there will be a lot of funding in the US itself that may actually crowd out some of the funding that goes elsewhere in the general economy on one hand. Secondly, for our own economy, we cannot continue to plead with foreign investors to invest in Nigeria, because we know that funds go to two places. One, where the return is high, and two, where the risks are low. And until you're able to get a reasonable balance between those two, you are going to be wishful thinking to expect foreign direct investors, or for that matter, even portfolio investors, to come back into the economy. So for me, the about 20% gap between the R&E window rate and the parallel market rate is way too large, is way too wide for any confidence to be in that sector. I recall in the past we used to see a 5% and below, and that is when that window was quite active, and we're able to get a lot of foreign investors to take a risk of coming in, believing that yes, depending on how they go, they will be able to walk away with a bit of net margin in the market. But today, with the yield in the below 1% category, and then the inflation already in the almost 20% category, and then we're here talking about a 20% gap in one rate to the other. That room is way too wide, and we suspect that there has to be both structural correction as well as monetary policy correction. But I think the structural one are far more important and more impactful than even the monetary policy one. So there isn't much the CBN or the monetary policy itself can do today to say they want to actually get foreign direct investors to begin to look more at Nigeria compared to other environments.
All right, if you can make this quick, Bismarck, because I do understand that the Central Bank Governor is seated now and we should be crossing to him shortly. But if can you just chime in very quickly on the Forex policy issue, because as I mentioned, I think that is the big elephant in the room.
Okay, firstly, $17 billion of emerging market investors went to emerging markets in the first 3 weeks of this year. We have a maturity of $500 million on the Eurobond day after tomorrow. Nigeria will meet that obligation, but Nigeria definitely begins to struggle as soon as we begin to see oil price volatility increase. So we need to address the exchange rate and the flexibility of the exchange rate, not just the exchange rate itself. It will appreciate sometimes, it will depreciate sometimes, but there has to be flexibility, and we have to stop rationing of foreign exchange. If we do that, then confidence begins to restore gradually.